Okay, continue with incremental cash flows. So side effects matters. We talked about erosion. Erosion's a bad thing. So our new product is going to take away sales or demand, reduce demand for other products. We have to take that into account. But if, for example, we have synergies, this new product makes people want more of something that we're selling, then that's a good thing. So estimating cash flows. So recall operating cash flow from operations, same thing. Operating cash flow or OCF is equal to EBIT, earnings before interest and taxes. So this is the entry on the income statement right after depreciation is taken out. So EBIT minus taxes plus depreciation. That's the cash flow that project is generating, for the company. So net capital spending. We don't, we have to take into account salvage value. We have to do that after tax because we're depreciating. In most cases, we're depreciating the full amount of the asset over the life of the project, and the asset will have a zero value after it's fully depreciated. So whatever we earn from the salvage or the sale of that product at the end is taxable. So we have to reduce the value of that by taxes. In the example upcoming, they use modified accelerated cost recovery system, and there's actually 5.76% of the value of the asset remaining to be unamortized or depreciated afterwards. So we have to reduce that when we calculate the taxes for the salvage value, and we'll talk about that when we walk through that problem. Changes in net working capital. So when we enter into a project, we may need more or less working capital. If we need more, it's a cost. If it reduces working capital, then it's a benefit. We'll see that in some of the cost saving proposals that we'll work in our homework. So, but finally, if there is a cost, it returns to you when the project is over with. Once you shut that project down. So, interest expense. We'll deal with interest expense later in the semester. So the impact that debt has on the capital structure of the firm and firm values, so forth. So for now, we just assume that the firm pays level debt and interest expense is independent of the project. So Baldwin Company. I'm going to walk through this in the lecture, but then I'm also going to do a video where I build this spreadsheet as well. So there will be a separate Baldwin Company video that will be posted as well. So Baldwin Company has been test marketing that project. They've already spent $250,000. That's a sunk cost. So current market value of the proposed factory site, which the company owns, is $150,000. So that's an opportunity cost. So we have to incorporate that into our analysis. Our new bowling ball machine is going to cost us $100,000, and it'll be depreciated using a modified accelerated cost recovery system on a 5-year basis. There are tables for modified accelerated cost recovery system. There is no calculation involved. I actually think, I'm pretty sure that Excel has an MACRS function. But The increase in net working capital is $10,000, so that's a cost. So the initial costs to the company are going to be the cost of the asset, the opportunity cost, and the increase in net working capital. So if there are no other costs initial costs, it's going to be $260,000 recognized in period zero. And then they give us production in units by year for the 5-year life: 5,000, 8,000, 12,000, 10,000, and 6,000. The easiest thing to do here is to create a spreadsheet. We're going to, this 5,000 is year one, 6,000 is year 5. We enter them across the top, we enter the periods, and then we can do our calculations based off those units. So during the first year, the price is price per unit. The sale price is $20, and it's going to increase 2% per year. So that's an inflation consideration. We're taking into account the price costs. However, production costs are $10 per unit during the first year, and then they're going to increase at a 10% rate. So again, we're taking into account inflation rate is 5%. That's actually is irrelevant to the project. So, and then they tell us that working capital changes with sales. So, but they don't tell us how it's calculated. So don't worry about those calculations. We're not going to. You won't see a project where the working capital changes after the beginning or in any other periods other than year zero and the last period. So they so the $100,000 costs. They have recognize the opportunity cost of the project, the net working capital. So that's another $10. So our total cash outflow is $260, and so the inflows. This is the net the net of salvage value. It's not actually not after tax. So, but anyway, so this is an inflow, and then the opportunity cost comes back in account, and then we get our working capital back account. In our last year, our inflows are $196.13. So these are calculated. They don't tell us how these are calculated. So the change in net working capital. So there's 150,000. So our sales revenues. So the year one is just the $20,000. I'm sorry. Let's go back here. The 8,000 for all right, 10,000 units at $20. That's all that. Sorry. So and then the next year, I think it's 12,000 in sales, and then that goes up. So so our sales here are 5,000, 8,000, 12,000. So it's 8,000. So the sales revenue in this year two is 8,000 times the $20 multiplied by 1.02. So that grows at the 2%. So that's $20.40 times multiplied by 8,000 is 163,200. So now the cost. So in the first year, that would just be 5,000 times or 5,000 units times $10 per unit. So or 50,000. Second year, you go down here, we've got 8,000 units produced at $10, and then it increases at the inflation rate is 10%. So 10 times 1.1. So that's $88,000. So now our depreciation. So this is right here is a modified accelerated cost recovery system chart. So it's 20% of the the cost of the machine in the first year, 32% in the second year, 19.2% in the third year. And if you go down here, that we're going to end up with 5.76% left over. So, all right, so we will start with the calculation of operating cash flow and net income on the next lecture.